Tesla shares are down 27% off the highs reached over the previous 3 months, and many Tesla stock investors are asking, why is the stock price falling? I thought all I had to do was buy Tesla stock and it would become a $10 trillion company like Elon Musk said. So what's going on here? I'll answer that question in this video. I'll talk about the reasons why Tesla's stock price is falling, and I'll also answer if I think this is a buying opportunity or what I think about Tesla stock, whether it's a buy, hold, or a sell. I'll share with you my discounted cash flow valuation model of Tesla so you could see my calculation for intrinsic value per share for Tesla stock. We'll look at the forward price to earnings ratio, and I'll look at a longer term trend line of Tesla's revenue growth, its operating margins, its cash flow from operations to come to the conclusion about what I think about Tesla in terms of buy, hold, or sell. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I mentioned in the introduction of the video, Tesla stock over the last 3 months is down almost 27%, and the S&P 500 index is down 0.8% in that time. So Tesla stock has considerably underperformed the broader market indices in that time. Why is that the case? Why is the stock price falling? Well, there's a number of reasons, most notably because of declining sales. So Tesla's UK sales fell nearly 12% in January of 2025, even as monthly EV registrations in Europe's biggest battery electric market surged to a record. So EV sales in the UK are going up, but Tesla sales are going down. In other words, it's losing market share. People are choosing other models instead of Tesla. That follows a 63% decline in January sales for Tesla in France, drops of 44% and 38% in Sweden and Norway, and 42% in the Netherlands. Big decreases in year-over-year sales for Tesla, while the overall market is rising. In California, the largest U.S. car market, with more than 1.7 million vehicle registrations in 2024, Tesla sales fell by 12%. So those are European, US, California numbers. When we look at China, Tesla sales in China are declining as well. So new data for early 2025 shows that vehicle deliveries in China fell by 11.5% in January, while one of its rivals, BYD, its sales numbers jumped by 49.16%. So it's losing market share in China, arguably one of the more important markets. It's the largest market for electric vehicles. It's the only market, in my opinion, where people want electric vehicles. Other places in the world, people are buying electric vehicles because of all of the government incentives that are going in, the thousands of dollars of rebates and incentives that you're getting. And still, in the United States, let's say, less than 1 out of 10 people are choosing an electric vehicle, even with all that stimulus. Whereas in China, it's more like 3 out of 10, 4 out of 10 people are choosing electric vehicles. Much better numbers, right, than other parts of the world where people are not choosing electric vehicles all that often. So these declines in sales, these declines in market share worldwide for Tesla are the primary reason why the stock price is falling. And this is the case, usually the case with Tesla stock. When the real numbers start coming out, the stock price starts to decline. And then as you get further away from numbers and the CEO gets to talk about dreams about the future, then the stock price rises again because it gets separated from reality. When Tesla stock faces reality, it comes down. When it gets separated from reality, the price can go up because the CEO is constantly boasting about this $10 trillion opportunity here, this $100 trillion opportunity there, and just throwing out these massive numbers that gets people to get excited and buy into that dream, where then the numbers come out and then investors are like, wait a minute, how are you going to achieve those kinds of dreams when your sales are declining? and your rivals are increasing, and demand for your primary product, where you generate 80% of your revenue, demand is falling for these products. So that's why the stock price is falling, and understandably so. Now, longer term, you look back at Tesla's revenue growth rate, and in the most recent quarter, it was just 2.15%. And that's down big time from the revenue growth rates before the outbreak, before COVID. Tesla was growing sales at 60, 70, 100%, right? And then it had a brief spike during the pandemic because of these unprecedented circumstances that favored Tesla, because its rival automakers were not producing as many vehicles, so it got a brief spike in sales. But that was a short lasting trend. The longer run trend for Tesla is declining growth, declining sales growth for its electric vehicles and its sales overall. Even though the energy segment is growing very nicely, it's still a relatively small part of the business overall, around 10%. Still, more than 80% of the business comes from electric vehicles, a category where Tesla is growing to face more competition, especially in China, and it's not experiencing growth. In fact, in the most recent year, in the most recent quarter, it reported a negative 8% year-over-year growth rate in vehicle deliveries. Similarly, when you look at its operating profit margin, it was rising all the way up until 2023. And then now it's on the decline, 7.94% in the most recent quarter. That's down from around 20% in 2023. And management has said this is likely going to go down further, as they said they're focusing on volume growth. So they're going to continue offering incentives, discounts, promotions, whatever they can do to try and sell more cars. And they're okay with sacrificing these margins because they still have the best margins in the car industry. So they can afford to continue pressuring other car makers and bringing down industry-wide profitability. They're okay with that. They want to increase the number of units on the road, and then they hope to sell software updates to those people that bought Tesla cars. Selling the supervised cruise control or supervised self-driving to the people that bought the cars for several thousands of dollars can really boost Tesla's profit margins in the future. Similar story with the cash flow from operations. That started to decline as well. Although they've done a better job as sales are falling for electric vehicles, they're also bringing down production. They're not investing in new manufacturing facilities. Tesla's focusing on maximizing its existing facilities, which they said they can produce up to 3 million units, and they're only selling like 1.8 million units right now. So they don't need to invest in a new facility. But that new facility was supposed to produce that lower priced model, which they have been promising for about a decade, of $25,000. That's unlikely to happen because they understand that demand for these vehicles is not growing, and they understand that they probably can't produce a model and sell it for $25,000 without losing significant sums of money on that sale. So that prospect is also diminishing. One of the more important metrics to consider when you're evaluating a business is the return on invested capital. What's the company doing with the money that you're giving them? And is it generating sufficient profit to justify investing in that company? And for Tesla, the answer is increasingly no. The return on invested capital, after spiking all the way up above 20% briefly in 2023, remember, these are unprecedented circumstances in 2020, right? Short-lasting, short-lived, because of the pause in production of other automakers because of COVID and the supply chain shortages. Once that eased and other automakers ramped up production, the competition is very much hurting Tesla, as you can see with the year-over-year growth rates and the numbers in electric vehicle sales. So the returns on invested capital are on their way down, 9.57%. This is likely to continue lower as well because of the facts I mentioned earlier. EV sales are falling for Tesla. The company's investing in incentives and promotions and interest rate discounts and whatever they can do to generate sales, but that's coming at the expense of profits. So profit margins are likely to decline. And unit sales are looking like, so far year to date in 2025, it looks like it's going to be down year over year. Unless, of course, they do deliver that lower priced model in the first half of 2025, which is very likely to boost sales if they can produce that model. Early rumors suggest that the model is going to be priced at around $37,000 and not anywhere near $25,000 like they promised. If they can get anywhere near $25,000, even if they can get it near $30,000 and sell it at $30,000, I think that's going to be a big boost for Tesla. I think sales will increase in terms of unit sales. Overall revenue might still decline because they're selling lower priced models, but unit sales will increase, which is a key for Tesla because then they can sell those services to those buyers, the supervised self-driving, which is a very profitable product for Tesla, but not very many people are buying it. And estimates are that roughly 1 out of 10 people are upgrading to the supervised self-driving. If Tesla can increase that uptake of the number of people that are buying the supervised self-driving, the more profitable sale, that could really boost the company's prospects. All right, so let's look at valuation. Tesla stock, following this decline over the last 3 months, is now trading at a more reasonable valuation. It's trading at a forward price to earnings of 86. It was trading at one point a forward price to earnings of over 160, which I thought was ridiculously expensive. And this is around when I rated Tesla stock as a sell. And I said this was a great time for Tesla stock investors to take their profits, celebrate with the money that they've made, and get out while they can, because it's unlikely to go very much higher from here. This had all of the enthusiasm of the business already built in. This was pricing Tesla stock as if it was 100% going to achieve driverless car technology and that it was going to generate hundreds of billions of dollars from this technology. And then 10 years later, it was going to have robotics and it was going to generate hundreds of billions from that. It was all pricing in that perfection into the business, which is unrealistic. The probabilities of those outcomes are a lot lower than 100%. They're probably a lot lower than 50%, in my opinion. So a forward price to earnings of 86 is right about where the stock was trading for around July of 2024, before the enthusiasm as a result of the election and the stock price increase, just because Elon Musk helped President Trump get elected. And for whatever reason, investors thought that was going to increase Tesla's profits or cash flow. I couldn't see the connection. And so I rated Tesla stock as a sell. At that point in time, I thought it was overvalued. So today I updated my cash flow valuation for Tesla and I increased my intrinsic value per share. Previously, my intrinsic value per share calculation was around $44, $45 per share for Tesla stock. Today, I upgraded it to $82 per share for Tesla stock because the free cash flow forecasts improved. Most notably, the free cash flow forecast around 2027, 2028, 2029 got a big upgrade from Wall Street analyst. And so when I incorporated that into my updated valuation, the intrinsic value per share rose to around $82. So what do I think about Tesla stock now? I mentioned already I've had it rated as a sell for a couple of months now, and the stock price has come down considerably and the valuation has come down considerably. So I am upgrading Tesla stock today. I no longer think it's a sell. I think it's a hold or a market perform. I still think this stock is overvalued and I wouldn't buy this stock at anywhere near these prices, but I don't think it's like ridiculously overvalued anymore. I just think it's overvalued and that's okay. You don't have to sell every business that you own that's overvalued. That would create too much transactions in your portfolio, buying and selling whenever a stock gets a little bit overvalued. Now that the price has come down and the forward PE valuation has nearly halved, I just think it's an overvalued business that I would not want to own, but I don't think it's so grossly overvalued now that I would recommend selling and getting rid of it.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.